Hey, Brett Swarts here, Capital Gains Tax Solutions. On this video, we're covering the promissory note and how you get paid back in your deferred sales trusts. So let's dive right in. The promissory note is the asset you own now, right? Versus owning the asset. You lent the money to the trust and the trust owes you the money. So you become the bank. So the trust owes you the money, right? The promissory note is the asset in which secures your right to the collateral. So typically these are written out somewhere around a 6, 7, 8, or 9% compounding rate of return net of fees is what's owed to you on the amount that goes into the trust. And so let's just say it's a $10 million total net proceeds into the trust. Let's just say it's at 8% interest rate. You're looking at about $800,000 of interest that's going to be accruing every year. Now we need to go make the money, make the investments to earn that interest, but that's just your promissory note as a whole. In fact, let's dive right into what this looks like here in just about 20 seconds. But in the meantime, I want you to like this video. If you can, watch it on YouTube. Like it, that'll help to get the algorithm moving, and also subscribe to the channel. That'll give us an opportunity to help more people like yourself that are exiting highly appreciated assets and want to defer some capital gains taxes. But let's dive right in. So this is a sample promissory note amortization schedule. And you see here, let's just imagine someone had closed an asset on 1/1/24, $10 million went into the trust, and the interest starts to accrue immediately. And in month one, it's about $67,945, or an 8% interest rate that's compounding and building. And in this scenario, let's imagine you are the seller and you are not taking any payments for at least the first 12 months. We have sellers of businesses, this is often, or even real estate, this happens where they want to delay the income for a period of time. There's some strategy around that of how you can move into another state, establish residency, and start getting the income on that state. But that's something to think about here, that you can delay the payments from the trust for a period of time. We typically like to say somewhere around 24 months is when the payment should start. Although in this scenario, we're going to see that this particular seller, they're wanting payments starting 1 year from the time that the trust closed, which is in 1/1/25. They're going to start out at a $400,000 payment. And so the trust itself is going to go earn some interest. In the meantime, the interest is going to accrue. We need to go earn the interest inside of a, some kind of investment. We're seeing some stuff right now at around 10% on some of the stuff that we're doing with lending, multifamily lending, and a very low LTV lending fund that is producing about 10%. And so in this scenario, that would be earning inside of the trust. And then there's some fees involved with the trust. But essentially what we're trying to achieve in this scenario is 8% compounding net of the recurring fees. So if you had 10 million, you see the interest that's accruing every single month on the promissory note. And hopefully we're also earning that amount at least. Also, hopefully we're also earning beyond our fees, because we define winning here at Capital Gains Tax Solutions is not only your original amount that you put in, but ideally that stays there. You cash flow the fees. That's the way we structure it. And then any excess, right, would be able to pay you. And hopefully there's even some more that can accrue along the way. All right, so fast forward 1/1/25, $400,000 is the payment. Well, you're asked, well, what about the other $400,000 that should be accruing? Well, in that scenario, that's going to also compound and build up. And so on month 1/1/25, you're going to have accrual of about $759. That's accrued over that whole year. In this scenario, $71,000 would be the interest for just this month. $400 would come out, and that would cover a lot of what's accrued in that previous year. And then it continues on down the road here until the promissory note has come to a balloon payment, which is typically 10 years. And now you say, well, what happens at that 10 years? Well, you can renew the promissory note. You can renew the promissory note. Or refinance is a better way to think about it, and you can basically extend out the note. It could be for another 10 years, it could be 5 years. We could customize that based upon when you might want to receive the total balloon payment. But most of our clients are probably going to renew. They're going to have partial interest payments. They're going to let the other amount accrue. In other words, they're going to keep that principal intact, compounding and building. So this is the promissory note and how it works with the deferred sales trust. If you have any questions on this, you can always go to capitalgainstaxsolutions.com. You can learn more about what we're doing there and how we can structure your next exit. And as well, you can check out Building a Capital Gains Tax Exit Plan. It's our brand new book that we released, and it talks all about the deferred sales trust. You can find that on Amazon. Hey, please rate, review, subscribe again to the channel. We so appreciate everyone out there, and we look forward to talking to you again real soon. Bye now.